So we're going to start off talking about some of the major economic factors that we have seen in 2025, going to continue throughout the rest of this year and carry over into 2026. And there's a lot of different factors that impact this. We're going to highlight a select few today that we feel are the most impactful and have the best ability to be actionable to work around as these market conditions sort of continue. So there is still some large impacts when it comes to inflation, and we still see interest rates very high. And that is, of course, making the cost of debt very expensive, making it hard for anyone to do any type of new real estate transactions. At the same time, we're sort of seeing some softening in the labor market. I think if everyone saw the recent jobs report, it gave some pause to a lot of folks. And we're also coming off of the heels of some of the largest level of new unit deliveries that really peaked in 2024. We saw a lot at the beginning of 2025, but that's now greatly slowed down, and we're going to see far fewer deliveries going into 2026. We also saw some really good news that a large portion of the new deliveries that we've been seeing are in the build to rent and affordable housing sectors. And we think there's going to be a lot of demand and increase for that, going forward. So let's start off talking about the cost of debt. I think a lot of us are familiar with a symptom of this. It's sort of the locked in effect that we've seen throughout this year, where if someone was looking to make a purchase previously before interest rates went up, right, they were looking at a certain value asset and a certain value debt service. And now that has changed. For homeowners, they can't go buy a house in a nicer neighborhood. They'll actually have to pay much more for a lesser home than they have now. You're also seeing on the investment side. You're expecting a certain debt service against a certain rent income, and those rents may have even fallen, right? So all of this has led to a real decrease in demand. That has softened in some markets more than others, but you've seen the demand for housing of all types slow down. You've even seen it apply to rental housing, where you have folks that, I'm going to stay in this rental home because I can't go buy a home, are moving to a new rental. Rental prices have went up the past several years. It would cost me more. I'm comfortable where I'm staying. So this has slowed everything down in the market. It's put a lot of capital on the sidelines. You've seen a lot of developments slow down, a lot of those not get started. And so, because of that, that is the supply side in a lot of ways, and plus the demand side that you see, right? So, supply and demand is still the major driver for this. So, we have a massive amount of supply. With all of those deliveries and the lessening demand, you're seeing units on the market longer, right? So, you have a heavy increase in supply. And because of that, rents have really started to slow down. I think throughout the entire country, we've seen less than a percentage in rent increases is the national average, I think, at this year. Some markets have done a little better. Some markets have done far, far worse. And so we are continued to see both supply and demand, heavily impact these markets.